Most people learn about Tulip Mania as a story of collective insanity, a bizarre moment when an entire nation lost its mind over flowers. The cautionary tale of greed run wild, of people trading houses for bulbs because they were simply stupid. But if you look closely, closer than the economics textbooks ever dare, you'll find a different story. Tulip Mania wasn't madness. It was the predictable outcome of a perfect economic storm. New wealth colliding with limited investment opportunities, a commodity with built-in scarcity, a futures market without regulation, and leverage without limits. The Dutch didn't go crazy. They went logical, terrifyingly, mathematically logical, right up until the moment the math stopped working. Welcome to Moments Between, where the stories you think you know are never quite what they seem. To understand why tulips became worth more than houses, you have to start decades before the crash. The Netherlands in the early 1600s was the richest place on earth. The Dutch East India Company was generating returns that would make today's tech startups look modest. Amsterdam had become the financial capital of Europe, home to the world's first stock exchange. Dutch ships controlled global trade routes, and the profits created something Europe had never seen: a large, prosperous middle class with disposable income and nowhere to put it. Because here's the problem with being rich in the 1600s. Your investment options were terrible. You could buy land, but ownership was restricted. You could lend money, but interest rates were capped by usury laws. You could invest in trade voyages, but those took years and carried catastrophic risk. What the Dutch needed was an asset that was scarce, appreciating, tradable, and new enough that no one knew what it should cost. Enter the tulip. Tulips had arrived from the Ottoman Empire in the late 1500s, but they weren't just beautiful, they were unpredictable. A plain bulb might produce a flower with dramatic streaks of color, spectacular variations that couldn't be replicated. These broken tulips were caused by a virus, but 17th century growers didn't know that. They only knew certain bulbs produced masterpieces. It was horticulture meets lottery, and the Dutch immediately saw the financial angle. The biology made tulips the perfect speculative asset. Tulips grow from bulbs that take years to mature. A planted bulb flowers once, then needs the entire growing season to rebuild. It produces 1 or 2 small offsets per year that need several more years to reach flowering size. Even if you owned a rare variety, you couldn't flood the market. Scarcity was hardwired into the flower itself. Supply was constrained by nature. Demand was unlimited by culture. At first, the market was civilized. Wealthy collectors traded rare specimens. Professional growers sold bulbs during summer months when bulbs were lifted from the ground. But as demand grew, something remarkable happened. People began trading tulip bulbs still in the ground, making contracts for future delivery. This wind handle, or wind trade, transformed tulips from a commodity into a financial instrument. You didn't need to possess a bulb to trade it. You needed only a contract. The Dutch had just invented tulip futures, and they did it in taverns. By 1636, a full-fledged derivatives market had emerged. Traders met in taverns throughout Dutch cities, especially Haarlem. These gatherings, called colleges, operated like informal exchanges. Drinks flowed and contracts changed hands in mounting excitement. The mechanics were sophisticated: standardized contracts, margin trading. Buyers could purchase with only a fraction up front. Leverage amplified gains and losses. But in 1636, no one was thinking about losses. The psychology took over. People were no longer buying tulips because they valued the flowers. They were buying because they expected someone else would pay more tomorrow. The greater fool theory in full effect. And why wouldn't there be another buyer? Prices had been rising for years. Your neighbors suddenly displayed new wealth from tulip trading. FOMO compelled people to enter even as prices reached absurd levels. The social composition shifted. Weavers, carpenters, farmers abandoned their trades to speculate. Even chimney sweeps were trading contracts. Fractional trading made it accessible. You couldn't afford an entire rare bulb, but you could buy 1/20th of a share. The prices became astronomical. The legendary Semper Augustus sold for 6,000 guilders, the price of a grand Amsterdam house. A skilled craftsman earned 250 guilders per year. That bulb represented 25 years of wages. For a flower, records document one bulb traded for 2 lasts of wheat, 4 oxen, 8 pigs, 12 sheep, wine, beer, butter, cheese, a bed, clothes, and a silver cup. Everything a household owned. But here's what most people miss. At every price level, the market made sense to participants. When a bulb sold for 1,000 guilders, someone paid because they'd watched 500 guilder bulbs double. When it hit 3,000, someone paid because they'd seen the 1,000 guilder bulbs triple. Each transaction validated the next. Each new high proved the market was rational. When everyone around you is getting rich, skepticism feels like cowardice. The crash came in early February 1637. At a routine auction in Haarlem, bulbs failed to meet their reserve price. For the first time in months, there were no buyers. Word spread. The spell broke. Suddenly, participants realized they were holding contracts for overpriced flower bulbs, valuable only because everyone believed someone else would pay more. Once that belief evaporated, everything collapsed. Within days, prices dropped 50%, then 75%. Then 90. Bulbs that sold for thousands found no buyers at any price. The chains of obligations unraveled. Person A couldn't pay. Person B, who couldn't pay Person C, fortunes disappeared overnight. Families who mortgaged homes faced ruin. Courts flooded with lawsuits. Buyers refused to honor contracts. The government's compromise, contracts could be voided for 3.5% of the price, was never fully enforced. Most speculators walked away. But here's the twist. The broader Dutch economy barely noticed. The Golden Age continued unabated. International trade flourished. The great merchants were largely untouched. Tulip Mania was catastrophic for individuals but not systemic. The Dutch economy was so robust that even a spectacular bubble bursting couldn't bring it down. Which raises the question, if it didn't destroy the economy, why do we still talk about it? Because it's useful as a morality tale. But the lesson most people draw is wrong. The lesson isn't people are irrational. It's that people are perfectly rational until they're not. Every decision made sense based on recent experience. Every price was justified by the previous price. The market wasn't irrational. It was hyper-rational, functioning exactly as markets do when new wealth meets constrained supply, meets leverage, meets FOMO. And here's where history folds into the present. The same pattern has repeated dozens of times since 1637. The South Sea Bubble, Railway Mania, the 1920s boom, .com, housing crisis, cryptocurrency. Each time, participants believe it's different. Each time, new technology or theories justify rising prices. Each time, skeptics are dismissed. And each time, the crash comes, swift, merciless, obvious in hindsight. The mechanics are always the same. A legitimate asset with real value, constrained supply, new wealth-seeking returns, financial innovation creating leverage, prices rising steadily, validating the market. A psychological shift where buying is about selling to the next buyer. A moment when everyone is in, leverage is maxed, and there are no greater fools left. Then the recognition, sudden, collective, devastating, that the price was never real. It was only ever a shared hallucination. The tulips themselves were never the problem. They were beautiful flowers, legitimately rare, genuinely valuable. The problem was the market built around them, the contracts, the leverage, the speculation. When tulips were flowers, they had value. When they became financial instruments, they became bombs. That transformation, from object to instrument to fantasy to rubble, is the story of every bubble ever blown. History doesn't repeat, but if you don't understand it, it'll crush you all the same. The next Tulip Mania is already forming somewhere. A new asset, a new story about why this time is different, and it will feel completely rational right up until the moment it doesn't. The crash always comes. The only question is whether you'll see it coming. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.